All right, continuing chapter 14, page 276. We were last talking about private mortgage insurance, PMI, and this needs to be, if you get a loan, you need to carry private mortgage insurance anytime you put down less than 20% down payment. Conventional banking theory says that the lender is risking their depositors' money if they lend you more than 20% of the appraised value of the, I'm sorry, more than 80% of the appraised value of a property. So therefore, you put down less than 20. So the private mortgage insurance just covers the amount less than 20% that the borrower put down. For instance, if you put down 5%, PMI insurance will insure the other 15% of that 20% that you did not put down. Okay. So uh, these are all the highlights you should have here that, they were also from the notes from the previous slide, I believe. Let me see. Yep. Yeah, we already went over that stuff. And then how do they determine, when you've reached 20% equity or 22 when they have to drop it by law, the private mortgage insurance? Well, the lender will order a BPO, a broker's price opinion from real estate agents, or they'll have us do a CMA. They usually don't do appraisals and pay for expensive appraisals for that. Just remember that anytime we do a BPO or CMA, we have to put on there, it is not an appraisal and should not be considered the equivalent of one. All right. So FHA loans. Okay, FHA, that's the Federal Housing Administration. We're not talking about those FHA law. We're talking about Federal Housing Administration. So the FHA, let me take a look, see if this is down still, like it says here in the slide. I, I guess it is because when I click on the link, I get this. All right. So I guess they're not essential right now, part of government. So they're just sitting there on the sidelines during the government shutdown that we're currently experiencing, um, because there's a little congressional fight over just passing the clean continuing resolution to keep an operating government. I guess, as they're putting it, the radical left in Congress. I guess that's the people that are wanting to undo the big beautiful bill by reinstituting the major parts of it that they did away with for savings that were full of waste. Um, and funding for things that should not have been funded. That's basically what that is. I'm not going to get into that. Okay, so the FHA.gov it's a crappy site anyway. There was never one to begin with until Biden put one up. FHA.gov always operated under HUD. Now they did put their own site up, their own page, which takes you to here, and there really wasn't much information available here for the public anyway. But it looks like they started to tweak the site and put more information on it recently that could be used to help. That could have those informational resources. But if you notice the link down the bottom, it all points to HUD resources on HUD.gov. So if you click on any of these, like single family, or maybe not, what is this stuff? But all the links are going to the HUD's website, so the FHA.gov is nothing more than a landing page. So it's a pretty useless page. The government never really had anything up there of use anyway. So FHA insures loans, but they don't lend money. It insures lender for entire loan amount against loss. All right. So basically, the FHA does not lend money. It tells local lenders, it tells you, local lenders. You go to the local lender to get a FHA loan. FHA tells that local lender, hey, listen, if the borrower meets these lending criteria and the property they're purchasing meets these criteria, lend them your money and we will insure you against loss that you won't lose a penny if that borrower defaults on the loan. So this is just a government program that allows low down payments, okay, or higher LTV loans. It's another way to say it, right? Higher LTV, lower down payment. Only requires 3.5% down payment. Used to be 3%, and then they jacked it up. President Obama, during his term, he jacked it up to 3.5%. He made a couple of other changes, which we already spoke of too. Said that if you didn't put down at least 10% at the time you got the loan, you could never drop the mortgage insurance premium, the MIP. It's a little bit different than PMI. PMI insures the amount less than 20% the borrower put down. MIP is insurance for the entire loan. Now, it doesn't insure you as the borrower, it insures the lender from loss if the borrower defaults. That's why they're allowed, that's why we get these loans, because there's something in it for the lender. Less risk. Remember, we call it risk-based lending. And if the government's there to step in, if you default on your loan to make sure they don't lose a penny, the lender's like, what do we got to lose then, right? So, loans are for purchasing or refinancing owner-occupied 1 to 4 family homes. They're not for investors. You could only have one outstanding FHA loan at a time. It's directly tied to your Social Security number. Okay. Now, it's not like a first-time home buyer loan program that you could only use once. This program can be used over and over many times in your lifetime. You could use FHA loans, but you could only have one FHA loan at a time. So you could use this to buy your house, your first house, the FHA loan. And then when you get enough equity, refinance into a conventional loan. And then you could use an FHA loan again to buy your next home with low down payment of only 3.5%. So the FHA does have minimum repair requirements that the property be in livable condition, not requiring a lot of repairs. Well, why do they care about that? Well, because you don't have a lot of money. If you did, you wouldn't be needing an FHA loan and putting down only 3.5%, right? So they figure they're looking out for the consumer. Now, it requires an upfront mortgage insurance premium called MIP that's charged at closing. So this is, you're required to pay this one-time upfront mortgage insurance premium at closing. But that's all right. If you don't have the money, you don't need to pay it at closing. They could wrap that insurance into the loan. You could finance it. Leave it to government to make such programs up. This is insurance in case you default on the loan. However, therefore you're required to pay it up front. But don't worry if you don't got the money. You could finance it. And what does it insure? In case you don't make your payments. That's kind of odd. Anyway, that is what it is. It's a government program. So the monthly MIP payment, like I said, it can only be dropped when equity reaches 78%. Okay. It used to be after 5 or 7 years. President Obama jacked it up to 11 years. Not that most people in 11 years would pay off 78% of their loan anyway. But this is the pivotal part that he change that he made was he said that if you did not put down at least 10% down payment at the time that you got the loan, you can never drop this MIP coverage, this insurance. Because on top of that one-time upfront insurance payment that you could also finance into the loan, you're also going to pay a monthly insurance premium. But now you can never drop that. The only way to drop it is to refinance and get off the FHA loan program to a conventional loan. And I think that's the reason why he did it. He wants you to use the FHA loans to get into housing, but get the hell off the system as soon as you can, because when our mortgage market was crashing, it was half the loans out there were FHA loans. And who insured them? We, the people, right? So the FHA, and FHA, that's an insurance program. They get that money from those insurance premiums, and that went bankrupt really quick when people started defaulting on those loans. And then um, President Bush had to do a bailout. And then after that, President Obama came in and he had to do an even bigger bailout, a second bailout, because this fund went bankrupt again because it was trying to pay off all those defaulting loans. And they insured the lender from a penny against loss. So when property values dropped, were overinflated and they dropped to half the value of what the home was, well, those lenders were still insured for the full amount that they originally lent out, regardless of what the home values are today. So lenders were making out like bandits. So unfortunately, they didn't put rules in place for that, on how that CEOs can't walk away with golden parachutes and things like that. So a lot of this money got wasted. So maximum seller concession allowed for an FHA loan is 6% of the loan amount, not the purchase price. What is a concession? It's any money that the owner gives back, they concede, they give up, that's what conceding is, to the buyer for repairs or closing costs. The borrower may be able to finance some of the closing costs. By the way, 6% of the loan amount, not the purchase price. Now, the borrower may be able to finance some of their closing costs. Wow, with an FHA loan, you could finance the insurance premium and you could also finance some of the closing costs. The down payment's only 3.5% down. So what? It could end up being that you're borrowing more than 100% of the loan? Yup. It's an F8, it's a government program, not meant to make sense. So any or all of the down payment and closing costs can be a gift, not a loan from the buyer's relatives. Why not a loan? Because then that would change your debt to income ratio, and then you could possibly not qualify for the loan anymore. So if your relatives are helping with money for down payment or closing costs, it needs to be a gift and not a loan. And the FHA is going to want them to certify that in writing, that it is a gift, not a loan, which does not need to be paid back. So because it's in writing, if it is a loan, they better be very trusting that you're going to pay them back, because they legally can't collect on it in any way. Anyway, FHA loans before this, older FHA loans made before December 15th, 1989, are assumable. They can be taken over by anybody. He doesn't even need to qualify for the loan. However, the newer loans after that date from the FHA, they're still assumable. However, the borrower needs to qualify for the loan still, but they're still saving money by just taking over someone else's loan, because they don't have to pay for, appraisals and loan origination fees and closing costs, because the loan is already in existence. Now, FHA 203K loans, K for construction. I know it's not spelt that way, but that's the way I remember it. 203K. So the regular FHA loan is the most popular loan. It's called the 203B loan that most people get. 203K loan is K for construction. It covers it allows one loan to cover the cost to purchase the real estate and additional loan for extensive rehabilitation work that you may want to do on your house. So if you want to buy a fixer-upper using an FHA loan, which loan product were you going to use from the FHA?
203K.
The 203K. K for construction, even though it's not technically construction, because construction is a new loan to build, to construct, to make new. This is a rehabilitation loan, like if you want to remodel the kitchen or put an addition on the house. Now, is there any limitation on these FHA 203K loans? I'm going to show you. You'd be shocked what is considered extensive rehabilitation. Now, There's a special amendatory clause that all FHA and VA loans need to have in them. It says that if the house does not appraise for the purchase price, the borrower can get out of the contract without penalty. All right, so that needs to be added in by law to the contract of any property that somebody's buying using an FHA loan. Okay. Now, there are maximum limits on how much the FHA will loan you, depending on the county you live in. And that's like that throughout the country. So I'll have a chart here on the HUD website from actually a database here that'll pull up that information. And if you're buying a condominium, those condominium complexes need to be FHA approved as well. And what's required for a condominium complex to be FHA approved? Well, they have to use certain minimum criteria for the construction materials. They have to use a certain standard of minimum standard of construction materials for the condos. And you can only use an FHA loan to buy in a FHA approved complex if more than half the units are already sold and the majority of the owners are owner occupants, not renters. Because if they're renters, they know which direction this complex is going. The property values aren't going to maintain as well. Because who takes better care of their property? Renters or owners?
Owners.
Owners, of course, right? So anytime someone gets foreclosed on that had an FHA loan, FHA forecloses. Remember, they reimburse the lender to make sure they don't lose a penny. And then they turn the homes over to HUD, which then puts them on the auction block to recoup as much of that money as they can. However, in recent years, with the open borders and the ignoring of immigration laws and people just flooding in, we needed a place to house a lot of these folks. I mean, the government started paying higher than normal rents for rental properties. They even reopened closed hotels and motels and paying extraordinary, exorbitant rates for those rentals. Oh, by the way, where does the government get its money from to do this? Us, the taxpayer. Okay. Um, so this is why you saw all these, investment groups rushing out there to buy properties that they could then use the rent to the government because the government's paying higher than normal rates. Why do you think your rents are so high? Why do you think the purchase of real estate has gone up so much? Supply and demand, my friends. It's not rocket science, you know. This is why the HUD Home Store, that's the site that you go to find the available HUD auctions to get deals on those HUD homes. However, because of all of these agencies, the government agencies and private agencies, buying them all up so they could offer them up for rent, there's like nothing available. The inventory is so limited on these websites right now because the government's still using that. Well, shouldn't be anymore. Uh, but investors are still using that. Let's take a look and see if anything has changed in recent months. Okay, this is the HUD Home Store. Can you guys see the website? Did I change it? Yeah. Okay.
Yeah.
So this is the HUD Home Store website. Anytime the FHA forecloses, they turn it over to HUD, and then they're called HUD homes, which, by the way, only HUD agents can write contracts for sale of HUD homes. You need to get an NAID number to to do that. So your broker needs to be HUD approved, and you do too. You need to take a class because you need to know how to submit contracts and offers to HUD, and then you're the only type of agent that can put in contracts for HUD homes. Okay, don't call them auctioned homes or foreclosed homes because they're not. They're not foreclosed by HUD. They were foreclosed by the FHA. They're HUD homes now. Let's take a look. How many are available in the whole entire state of New Jersey? Only 12 properties now. Well, it's more than it was a couple months ago. Let me take a look. Delaware 4, 5. They're still very low numbers. It used to be at any given point in time, you could see thousands of homes available in every single state. Now it's like, oh, well, yeah, Texas got a lot, 206. You just run the mouse over, you see how I'm showing all these different ones. Why is South Dakota not showing, or Vermont? Oh, maybe they don't have any. Puerto Rico's got one. None in Hawaii. 72 in Florida, too. But let's take a look at New Jersey. So you go there to New Jersey, you can see the properties they got available. Let me see, in Dumont, wherever that is. Bergen County. Okay. Looks like a house that needs work. I guess Dumont's expensive because the opening bid is $500,000. $425,000 for brick. 405. Wow, these are some prices of real estate went up. Forked River, 405, 350 in Barnegat. Barnegat's not bad, Ocean County. It's only a two-bedroom, two-bath. Well, must be a condo or something. House over here in Hamilton, 330. That's all the inventory they got right now. Wow, that's some of the more expensive homes I've seen on the HUD website. Okay. And if they're unable to sell at these ridiculous prices at auction, what happens to them? Well, they go up on the auction block again, but they also get offered as dollar homes. HUD approved nonprofits can just grab them for free. And they're available for $1 to, let's see, the Good Neighbor Next Door program. For teachers, police, and firemen, they could get them for $1. Yeah. Government agencies have the opportunity to also purchase them for $1. Yep, that's a HUD home. All right, now I told you FHA does have maximum loan limits. Now, what kind of property can you buy with an FHA loan?
Residential?
So 1 to 4 families, right?
Mm-hmm.
They have to be owner occupied. So let's click on this. Let me close out some of those other windows. And that takes us here to the HUD Home Store. And if we take a look at all states, we drop down, we'll look at New Jersey. We can see what the limits are for how much you can borrow in each of the counties, 21 counties, for 1 to 4 family homes. And here's what the database comes back with. So here's the county name, and here's what the median sale price is in that county, and here's how much they'll lend for 1, 2, 3, or 4 family house, depending which county you're in. Atlantic County is one of the cheaper counties. So for a single family home, they'll end up to $500,000, a little bit more than $500,000. 2 families, 670, 3 family, 811, 4 family over $1 million. Bergen County is one of the more expensive ones. So for a single family home, you can now, this is insane, that they'll lend $1.2 million for a single family home, 1.5 for 2, 1.8 for 3, 2.3 for a 4 family. Wow. Real estate prices have skyrocketed again. Seems like a bubble to me. Let's see. We're in the, let's see, Essex is one of the more expensive, so they're in that 1.2 to $2.3 million range. Middlesex in that same range. What about Union? Union County's in that same range. You see how there's cheaper counties and more expensive counties? So you got to find out what county you're in. Although, that 1.2 million, that's I'm surprised they're lending that much. They've jacked it up quite a bit. All right. But I also told you FHA approved condo complexes, right? So Let's take a look at those condominiums. Let's take a look at New Jersey. Where's a town that has a lot of condos? You want me to look? Check out all the FHA approved condominium complexes.
West Orange.
West Orange City. West Orange. West Orange got a lot of condos now. Okay, so anyway, you can see here, anytime a condominium complex has been approved, it's good for 20 years and then it needs to get reapproved again. They need to submit the financial packages, the owner, whether they're owner or occupants, and the financials of the complex to get approval. So let's see, this one here, Crestmont Gardens, let's see, they currently have no FHA loans in them. It was rejected. Register single unit. I don't know what that means. Somebody tried to apply for that on 2022 and it was rejected for some reason. Rejected, register single unit, whatever that means. Another one over here, rejected. Rejected for missing documents or incomplete package. In 2010 was the last time somebody tried to get this complex approved for FHA loans. This one was once approved but expired and still has some FHA loans already in there. This one was approved and expired. On Eagle Ridge, approved, expired, approved, expired, approved, expired, rejected, other specifying comments. Okay. Rejected, approved, expired, expired. But you can see they still have FHA. There's some concentration of FHA loans in these complexes here that are expired. So nobody else will be able to get a new FHA loan in these complexes unless somebody submits a package and gets it approved by their lender. Rejected, missing documents, and they never supplied them and updated it. Approved, expired, rejected, rejected. But even these ones rejected, you could see this one has FHA loans in there, so it was approved at one point in time. So it must be over 20 years old because it's now being rejected for some reason or another. So that means it expired and they had to try to get it approved again. This one was rejected in February 2025. Somebody tried submitting. Rejected. Oh, approved. Hey, we found one. There's one approved complex in West Orange, and that's the West Essex Highlands. Status date and expiration date. Okay, but they're set to expire in 2026. So I guess that one's almost 20 years old, huh? As of next year. Let's see, what about Edison? Edison's got loads of them. Can we find any approved complexes in Edison or Woodbridge, maybe? Let's see. Nope. Not a single one in Edison. It used to be. I used to sell a lot of condos and used FHA loans. Looks like a lot of these have expired and nobody submitted a full application to get it approved again. I guess there's a lot of conventional type loans out there that are matching up with FHA that require low down payment. Interesting. Must be other loan programs making its way through. What about Woodbridge? Woodbridge got tons of condos, right? Rejected, 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 expired, rejected. Nothing in Woodbridge either. Somebody's got to commit to it. I guess there's other alternative loan programs out there for people that that they don't need the FHA with the low 3.5% down payment. You know, there must be other loan programs that people are using now to buy the condos or cash. I recently sold one in Island, which is within Woodbridge, and that one I had an investor for a one bedroom. Somebody investor bought all cash. Hmm. Yep,
Yeah, I got a conventional for 3% down.
3% down. Yeah, see, so what's the point of 3.5% down with the FHA? Plus they're picky about if it needs certain repairs, they'll reject you too. Because they're looking out for the consumer. But yeah, it looks like they're not as popular anymore. I guess if there's other programs available, but you still need to carry PMI insurance if you put down only 3%, right? But you don't got to carry that MIP like what you do with the FHA loans, which insures the whole loan amount.
Yeah, and I didn't know that before I refied, and
Yeah.
now I have FHA. Yeah.
Oh, you refi to an FHA? Well, you got a good interest rate, but you got to carry the MIP insurance. Hmm. Yeah, that's the part that sucks. That's the part that makes it a little more expensive. But let's see. What was your interest rate under the other conventional loan?
It was like five something.
Okay. So
Yeah.
yeah, what I recall, you got a pretty low one right now. It's like 3% or something, right? Hmm. That may make up for it. I'm not sure. That may make up for it, or maybe break even on the cost. Do you know? Are you experiencing any savings, or is it about the same?
No, my taxes went up and the insurance went up and it's in my mortgage.
Oh,
So
so it's tied in. So it's
yeah,
okay.
yeah.
Yeah, it's because the FHA has the MIP insurance coverage, and it's a certain percentage of the loan amount. So that payment may be making up almost the savings that you would have experienced. So you may be experiencing a little bit of savings, but if you are, it's not going to be much because of that insurance
I
premium.
noticed it probably the first year, and then the insurance went up, and then uh,
Then
the
you can't really notice because it's
taxes went
all
up. Yeah, it was.
taxes and
Yeah.
insurance, then kind of obfuscate the loan itself. Yeah, yeah. Uh, uh, all right. Well, let's take a look and see what else we got here. So the FHA lender site with great information. This is not an FHA. This is not government. This is not a government website. So let me clarify this a little bit here, even in the slideshow. Make sure I write in here. FHA lender site with great information. Not a government site. Hello. I got the spinning wheel. What's going on?
So if you wanted to use the equity in your home to get another property, what would you do?
With an FHA loan, well, you could refinance into a conventional, but right now that don't make sense for you because there's no way in heck you're getting that kind of interest rate anymore.
I'm looking at the HELOC,
Uh,
so it wouldn't. I don't know.
well, yeah, that's a second loan for getting your equity out, a home equity line of credit. It's not a refinance, but it's a second loan on the property to drain out the equity. That's one way of doing it without interfering with your current loan. You're just draining the equity out using that home equity line of credit. Yeah, that's one way you could do it to get the money out and use it for a down payment to buy another house. Mhm. I guess the other house. What's the purpose you're buying it for?
Rental property.
For a rental.
Mhm.
Uh, well, if you take out this loan and you're using it for an investment property, the interest should be tax deductible for you because it's an investment, right?
Mhm.
Uh, Consult with your tax professionals on all that stuff. But listen, I've had a then again, I've had a girl in this class before that she was involved already in fixing and flipping homes. You know, buying homes, fixing them, and flipping them. And I asked her, I said, "You're pretty young." I said, where are you getting all the money to do all this?" And she's like, "Well, you always get those credit card offers in the mail, people offering you, cash advances and all that stuff. Um, and I was like, yeah, but that's kind of a higher interest rate. And she's like, yeah, but I'm not holding on to it for that long. So I could get a loan. I could get some hard money loans from people to buy the house, to fix it, and to do fixing and flipping. But they don't give you all the money to do that. You need to have some of your own money to put down as a down payment. So, because I didn't have the money, I just borrowed it from a credit card and used that money to do the down payment to buy the house. And then, the other lender doesn't know. They just see the money, and uh, and then they give me a loan for the balance of it. Yeah. And she's like, I've been doing this for years. And then when I fix it, I flip it, I sell it, I pay it off. So she's like, yeah, it's a bit of a high interest, but now I'm starting to get relationships with banks and they're willing to lend me more money to do all the project. I'm like, okay, that makes sense. That's the way that it's a bit risky, but yeah, that's another way to do it. But if you're going to be holding on to it, don't do that. Don't do that. The high interest rate, you're going to get sucked in until you pay it off. But if you're fixing and flipping houses, that's one way she did it. I mean, I got lists I could on my fax machine. I could probably show you maybe 20 right now that I have on my fax machine where I'm constantly getting offers for hard money lending and fixing and flipping. And now they got these other loans that they don't even care about your income or assets. They just care about your credit score. They're the fixing and flipping type things, and you should have some sort of experience with doing it too. But they got those, what's it, DSLR loans or something like that. I forget what they're called. All right. They're just tied to your credit score and the investment property. Okay, so that's it for FHA. But if you guys have not yet, you may want to snap a picture of this because I got all the information for studying in one slide here for the FHA loan. Okay. I'm also going to click on this last one, the FHA.com, which I wrote in here is not a government site. It's actually a lender site. And they put a lot of good information there about FHA type loans. After you guys snap your pictures, if anybody's snapping a screenshot of that, I'll switch to the browser window to show you. Just let me know that everybody's done. Everybody got a screenshot that wanted one? Okay. So this is FHA.com, not a government website at all, but they got a lot of great information about FHA type loans. Okay. They 3.5% down payment. They got ones for refinance, loan rehabs, FHA ARMs, and fixed rates. And here they have the different options. 0% down payment possible with a grant. 3.5% down payment with required credit score minimums. Okay, well, with required credit score. Well, FHA doesn't have a credit score requirement. It's the local lenders that usually do. So just beware of that. And here's one with 10% down payment without required credit score. Hmm. And they're showing you the FHA loan limits. They vary throughout the country, but this is not for New Jersey here. You got to look up. I already showed you what New Jersey was. In the cheaper counties, it was in this kind of a range, but I think it was even higher than this. All right, they got tons of. I mean, you could go through all of their articles and stuff. They got so much information on this website. You need a closing day checklist. Okay. FHA loan limits for your website. Okay, well, you could get that stuff directly from the link that I gave you from HUD. So look at this. The current 30-year FHA fixed loan is 6.07% as of today. So you're not going to experience any savings if you were to refi your loan with you got it 3, right? 3%. But you can explore this website. It's got a lot of good information on it that you could check out. There's videos, articles, mortgage calculators. All right, moving along. Okay, so we have let's do now all the highlights for the FHA stuff. We had everything on that one slide that you need to know about the FHA. Now we're going to highlight that stuff over the next 3 or 4 pages in this book. Okay, so let me know when you guys have this, and then I'll move on to the next slide and next slide and next slide until we get past all the FHA stuff. Okay, so just let me know. Just verbally give me a nod. Let me know when you guys got it. Just say got it, so I know. Meantime, I'm gonna munch my breakfast here in the background while you guys. I'll take my mug off the screen and I'll wait for you.
Got it.
Okay, everybody good?
Yeah. Yes.
Okay, next slide. This is also page 276, and then from down here it's down 277. You don't need to write all this here, but I just wrote here, or if equity reaches 78% and the buyer put down 10%, it can be dropped after 11 years. You don't need to put all that down there.
Got it.
Okay, everybody good?
Yeah.
Okay, next.
Got it. Got it.
Okay. Next.
Got it.
All right. Here's a old builder's trick that you could use an FHA 203K rehab loan to do things like this. I don't know if that was used in this particular project, but often when somebody leaves up a portion of the building, it's because they're using a rehab loan. See, there's only one wall left and the garage. This wall eventually came down too. See that? The chimney. They just didn't tear it down yet because the power line was still connected to the house. And then they eventually built this thing, which is like almost 4 times the size of the neighbor's house. They built it all around the original garage. So in tax records, it still shows this house was built in the 1950s, remodeled in 2024. I think that's when it was built, 2024. Look at the size difference of those houses. Yay. All right, the VA loans. But that's an old builder's trick you could use to get those 203K loans and use them for extensive remodeling. So it's a little bit more beyond the just redoing the kitchen or putting a little addition on the house, right? So VA loans, formerly called GI loans. Anybody know what GI stood for? With the military, we used to call them GIs, the military members. Um, and we called them GI loans. GI stood for general issue. You know, that's back in the day where everybody got the same socks, the same underwear, the same boots, the same uniform, the same weapons, the same number of bullets and grenades and same everything. You know, they weren't promoting individualism and where you could express yourself in the military, you know, and all that nonsense that we've been seeing, which ended up leading to a dramatic shortfall of enrollment in our military, where you got people enrolling in the military so that they could get sex changes, you know, using the because it's important for them. Well, you know, Trump said, "Well, that's you're not really meant for the military because then those folks are never serving a day on a battlefield anywhere or doing their part. They're just going there to try to reap the benefits." So he said, yeah, you cannot serve because of your mental issues. If you want to get those things done, you get them done on your own time with your own money, not the taxpayers. So there's been a lot of changes, and then now we have our military back up to snuff again, where we're getting a lot more recruitments in it. But regardless of that, the VA loan is called the Department of Veterans Affairs, and the VA loan are loans that go to veterans. You must be in the military or a veteran in order to qualify for a VA loan, to get a VA loan for a veteran owned or co-owned 1 to 4 family home. Now, there's been some changes in the last couple of years, I think since 2001, in the VA loan program. They used to have loan limits uh, just like the FHA, but now they changed it up a bit. The VA no longer has loan limits. They'll guarantee 25% of the loan, which was always the deal, to the lender in case the borrower, the veteran, defaults. But they only give loans for properties over $144,000 now. I don't know where that came from or why. I would imagine there's areas of the country where you could still get condos maybe cheaper. But so they only give loans for properties over $144,000. So therefore, no down payment is required. These could be 100% financing because the VA is guaranteeing 25%. It's as if the veteran put down 25% because that money's guaranteed by the from the VA, the government, right? So the lender usually doesn't require any down payment because of that, and thus no PMI, private mortgage insurance. So therefore, no down payments required. So they could be 100% financing depending on the lender. And the borrower must qualify for the loan based on their credit history and their income and assets. They also require that special mandatory clause that the FHA loans do that say if the house does not appraise for the purchase price, the veteran can get out of the contract without penalty. The appraisal statement for a VA loan is called a Certificate of Reasonable Value, abbreviated as a CRV. You will get questions on that on exam. You do need to know that for exam. What do you call the appraisal statement for a VA loan? A CRV. I just tell people, just remember the Honda CRV, the car, the vehicle, the Honda CRV. And for some reason, a lot of people remember that, but it's the CRV, Certificate of Reasonable Value. Okay. Discount points may be paid by the seller, the buyer, or shared between them. There is a funding application fee in order to get these loans that may be paid by the veteran or the seller or split between them. Now, the amount of that funding fee varies depending on the amount of down payment, and National Guardsmen and reservists pay higher funding fees because they're supposed to only be like part-time military. However, in recent years, when we had shortages, we had people re-upping, and these guys from the part-time military, the National Guard and reservists ended up actually serving those roles of the regular military personnel for a long time. So hopefully they did not have to wait those longer periods to get their benefits like they normally do because they were not serving that part-time during that term. So VA loans can be assumed by anyone. Ooh. So you need to be a veteran to get a VA loan, but you do not need to be a veteran to assume a VA loan, to take one over. Interesting, and probably sounds like an exam question. What do you think? So far out of this, what I got is you can only get a VA loan if you're in the military or a veteran, right? For 1 to 4 family owner-occupied homes. They got to have that special amendatory clause in there. You got to have the VA appraisal is called a CRV, Certificate of Reasonable Value. And even though you need to be a veteran to get a VA loan, you do not need to be one to assume a VA loan. And here are some of the requirements that you do not need to study in order to qualify for veteran benefits, military benefits. You have to serve 90 consecutive days of active duty during wartime, 181 days of active service during peacetime, or 6 years if you're in the reserves or National Guard. Hopefully, those reservists and the National Guardsmen that have been serving on front lines over the last couple of years, when we've been experiencing a shortfall of military personnel, they because they were serving, front lines and stuff, even though Congress didn't declare a war that they were in, but they've been on some front lines, so hopefully they qualify for those benefits still too. See, that's the thing. When Congress starts playing with these games, oh, we did not declare a war, so there was no war, so the veterans don't get the benefits because they were not during wartime, politicians play those games with other people's lives and the benefits that they could get that they earned. All right, so here are some resources and some links for VA loans. And if there are where is it? Is this a benefit VA loans? I did have a link somewhere for foreclosed on. Oh wait, they may turn it over to HUD actually when the VA loans get foreclosed on, if they get foreclosed on. So here's some resources: benefits VA.gov home loans, benefits.va.gov/home loans. So no down payments required. Lenders may require down payments for some borrowers using VA home loans guarantee, but not VA, not require down payment. Competitive low interest rates, limited closing costs, no need for private mortgage insurance. And the VA home loan is a lifetime benefit. The guarantee can be used multiple times. It's good to be familiar with VA loans. Helping veterans and their families relocate and move, where they often do get relocated after basic training. Then they get relocated all over the United States to other camps and then perhaps to other parts of the world. So if you take one of those classes to familiarize yourself with VA, VA relocation, become a veteran a relocation specialist, that's good. You're helping our military personnel, and you can make a decent buck here with helping them out. So anyway, here's a resource. That's just another resource I gave you, that website. And I got a little notation down here because I always talk to you about movies and documentaries and stuff. These are just pretty cool movies that I usually bring up in class and I talk about them, but we don't got the time to. But so I'll just show them to you really quick. They're decent movies if you've never seen them. Stripes is a comedy. It's funny as hell, from the late 80s, with Bill Murray and all them. You don't see stuff like this, comedies like this anymore, but it's pretty good comedy called Stripes. If you haven't seen it, put it on your list of movies to watch. HBO miniseries Band of Brothers. Anybody ever see that one? That's excellent. It is if you like Saving Private Ryan, you guys will like this. Although it's a real movie based on it's based on documentary style, where they're even interviewing some of the veterans that were in the actual conflicts. They use their stories to base these episodes on. So it's like a 10-part miniseries, of movie. I've got that DVD collection. Not that I use the DVD player anymore, but yeah, they're pretty good. You can watch it on streaming media too. Look it up, Band of Brothers. It is excellent. If you like war movies, you'll love this one. It's very addictive to watch too. Okay, so here are the highlights now for the VA stuff. Everybody still writing or taking notes, or everybody done?
We're done.
Okay, then we have the NJHMFA program. That's the New Jersey Housing Mortgage Finance Agency. They offer below market interest loans with low rates. Little or no down payment at all is required. To qualified buyers, not investors, they have to be owner occupants who live in urban target areas. You apply through various local approved lenders to get the money. And they have programs for first-time home buyers coming up on another slide I'm going to show you. There's many special loan types: first-time home buyers, live where you work, off-peak hours workers, and in order to help relieve congestion on our busy roads. They've got loans for police, fire, and teachers as well. They have interest-free loans available up to $10,000 for homeowners using well water to get that water filtration system installed. And loans for first-time buyers include money for the down payment that does not need to be paid back if you live in the house for at least 5 years. So here's some of the contact information and resources for the NJHMFA, the phone number, the websites. They got njhousing.gov and the roadhomenj.com. That's for the consumer resources with a lot of videos and resources. The home buyer's guide brochure that they have at this link. I already shared that with you once before. And for their foreclosed properties here in New Jersey, you could take a look at the REO properties right here on the DCA's website, which takes you here, and it is still open. So let's click on that. See if there's any properties actually available in New Jersey. All right. Yeah, New Jersey got a couple, 14 properties. In Burlington, Cumberland, Essex, okay, Newark, Trenton, Red Bank, Eatontown, Red Bank, Cedar Knolls, Pompton Plains, Toms River, Montague, Elizabeth. Let's see what's available there in Elizabeth. So they'll have the real estate agents listed property. I get the listing for that. Let's see if it actually comes up. What's taking so long? Oh, here we go. I guess the broker's website is slow that it's pointing to. Maybe they don't have the listing anymore. I don't know. MLS Direct Realtors. Who's that? It's supposed to be a brokerage. I guess so. They named themselves MLS Direct. Property preservation. All right. No link directly for that. But I guess they got the contact information and info of the agents here. I thought they're going to have links to the actual property. Can we see a listing? More info. Hard to get any information from them. I guess you got to contact the agent and try to get a listing number. Well, they got the address. You can look that up in the MLS once you become a member, but this site's not very helpful for those searching for homes, though. All right, so that's that. Now, New Jersey Housing Mortgage Finance Agency, let's do these highlights. They give loans to people with little or no down payment to qualified buyers who purchase homes in what areas? Urban target areas. Sounds like an exam question, hint, hint. The loans are for 1 to 4 families. They're not for investors. It was on page 279.
Got it.
Good.
Okay. This long link here, by the way, doesn't work anymore. This is the new link for it. So you'd have to get that from the slide. But I actually sent it to you guys once before too. This is for their home buyers guide. Remember, I sent you 3 of them. One from oh geez, I forget. One from the CFPB, one from the Real Estate Commission, and one from NJHMFA. Okay, so here's their down payment assistance program, or DPA program, they call it, for first-time home buyers. Now, what is a first-time home buyer? You're classified as a first-time home buyer if you did not own a home in the last 3 years. So you could have owned a home in the past, just not in the last 3 years, and boom, you're a first-time home buyer. Borrower's income must not exceed 140% of the median income to qualify for the loan. Second loan of up to $15,000 is available for down payment assistance, in addition to another $7,000 for first generation home buyers, for a total of $22,000 that's available when purchasing a home. It must be combined with the NJHMFA mortgage loan, the 30-year fixed competitive rate insured loan program that they offer. Buyers used to have to take a class in order to qualify for this loan. They taught you how to balance a checkbook. It was like a 1-day class. They taught you how to balance a checkbook and how to do some basic repairs, like how to replace a washer in a leaky sink. So you don't need, and replace air filters in your house's HVAC system, so that you don't need to be going and calling plumbers and experts and spending all this money for simple tasks you could probably do on your own. Because then people, they buy houses and they're calling experts to handle all the easy, mundane tasks. And they're like, wow, I can't afford a house. It's too expensive to maintain. So this is why they give these classes, these 1-day classes, to teach you how to do simple repairs. So you could save yourself all that money on some of the basics with home ownership. All right, so that was that 1-day class. I don't know. I said they used to have to take the class. I'm not sure. They may still have to. I don't know. The second loan for the DPA programs is 0% interest rate. It's self-liquidating, meaning it's a forgiving loan with no monthly payments if the owner lives in the house for at least 5 years. If you sell the house in less than 5 years, you got to pay. If you sell the house 5 years and you've been there 5 years or more, you don't pay any of that second loan back. Sell it in 4 years, you pay 25% of it back. Sell it in 3 years, you pay half of it back. Sell it in 2 years, you pay 75% back. And sell it in a year or less of having it, you got to pay back the entire second loan that was used for the down payment assistance. Okay. Interesting little program there. So here are some more of the NJHMFA's loan programs. You have that HFA Advantage 30-year fixed rate conventional loan. They have a first-time buyer 30-year fixed rate government insured loan. They have something called the Homeward Bound 30-year fixed rate government insured loan. I don't know what the difference between this one and that one is. You got to check with them. They have that one for police and firemen with that, which uses that pension fund to give them loans against, I guess. And you have the DPA, the down payment assistance program, that's self-liquidating loan for the down payment and closing costs. Now, once again, here is the phone number for NJHMFA and their 2 main websites. And here's some direct links to their lender list that are approved to give their loans under certain programs they have. They have mortgage calculators, frequently asked questions, home buyer's guide, which I already shared that link with you, and the water filtration system loan that's at 0% interest for $10,000. So these are just some resources I gathered and put together for you guys. They're also in the class links Word document. So if you need to get them, you get them from the slideshow or the class links Word document. All right, then we have the REC-D. That's the Rural Economic Community Development, formerly called the Farmers Home Loan Association. They're for 1 to 4 family homes, not for investors, for low to moderate income, first-time buyers, farmers, and people that just live in rural areas. That includes on Indian reservations. Subsidized interest rates are as low as 1%. Coletta, you live in a rural area by chance? Okay, I just checking. You never know. 1%, that's pretty good, right? For modest homes in rural areas, loans are directly from the USDA. So they're funded. They get the money directly from the United States Department of Agriculture. So 100% financing is still available today. And here's some of the resources there for their websites. So let's do the highlighting. Let's write actually here where it says Farmers Home Loan. I believe that's what it says. Let me see. Go to page 279 because I'm not there. Yeah, they call it the Farmers Home Loan. That's what it says in the book. You can write next to that, these loans are funded by the USDA for rural area homes.
Got it.
Okay.
Yeah.
And that's it for this chapter. So chapter 15 is done. Let's do the key, or 14, sorry. Jeez, that wasn't even 15 yet. All right, let's do the key terms to review and get on to 15. Wow. Mortgage payments that can be taken over by a next buyer.
Assumable loan.
3 is A, it's an assumable loan. Interest rates, highest interest rate ever allowed on a specific adjustable loan.
Ceiling.
The ceiling, 7 is B. A repayment plan, the equivalent of 13 monthly payments per year.
Biweekly.
It is a
Mortgage.
biweekly loan, yes. Where's that? 4C. A plan with interest rates changed, a plan with interest rate periodically changed up or down.
1 adjustable rate mortgage.
Yeah, 1 is D, correct, adjustable rate mortgage. A written estimate of value by a real estate licensee should not be considered an appraisal.
CMA.
A CMA, 8 is E. We also do BPOs, so BPO could also fit in there too, but we do them for lenders. A repayment plan of principal and interest that gradually reduces debt. It actually means to kill off slowly over time.
Mobilized loan.
Amortized loan. Yeah, 2 is F, amortized loan. Percentage beyond which interest rate cannot be raised at adjustment.
The cap.
The cap. Yep, 6 is G, the cap. Payment of extra points in return for a lower interest rate, and it makes no sense to ever do this.
Buy down.
It's a buy down. 5 is H. A difference between the current value and money owed.
Equity.
Equity. 10 is I. And VA appraisal statement.
Certificate of reasonable value.
Yep, the CRV, the certificate of reasonable value. 9 is J. Correct. All right, key terms 2. A loan guaranteed by the federal government. Who guarantees loans?
VA mortgage.
The VA. There you go. 10 is A. Protection for lender on low down payment conventional mortgage. What is the protection for the lender on the low down payment conventional mortgage?
Private mortgage insurance.
Yep. Private mortgage insurance. 7 is B as in boy. Mortgage payment including amortization, interest, and certain expenses.
Straight loan.
5.
Pity.
Yeah.
It stands for principal, interest, taxes, and insurance, and that's your entire mortgage payment for housing, right? So mortgage payment including amortization, interest, and certain expenses. That's a pity loan, also referred to as a budget loan. 5 is C. Percentage of property value that may be borrowed.
Loan to value ratio.
The LTV, the loan to value ratio, is correct. 4 is D. When the lender agrees to hold the interest rate for a certain period of time.
Rate lock.
It's a rate lock. Yep. 8 is E. 1% of the loan amount charged as an upfront interest when the loan is made.
A point.
It's a point. 6 is F. Low down payment insured mortgage loan. Who insures loans?
FHA.
FHA does. 1 is A, 1 is G. G as in Gary. All right. Mortgage with payments of interest only. What's another name for an interest only loan?
Straight loan.
Straight loan. Yep. 9 is H. Charge for the use of other people's money.
Interest.
It is. 3 is I. And a guide for national mortgage trends used for adjustable rate mortgages.
Index.
They tie it to some sort of an index, usually the 1-year U.S. Treasury bill. 2 is J. And that's correct. And that concludes chapter 14.